Hello everyone, welcome to this financial reporting topic explainer video on a very interesting topic which is financial instruments. I am your expert tutor Aleena Kareem. In this particular video, I'm going to dissect the whole topic of financial instruments for you for your better understanding and keeping a very good focus on the exam. A particular portion of financial instruments is tested in your FR exam, so we are going to keep our focus on that particular area. We are going to see how initial recognition measurement is done, how subsequent recognition measurement is done, and this is important because it is a topic which can come up in any section of the exam. You can get a 2-mark question in the section A or section B of the exam. It can come up as an adjustment in the final accounts question in your exam, and it can be a part of the interpretation question as well. So without any further wait, let's move on to the topic and see what financial instruments are and how can they be accounted for. Let's begin the topic with understanding what financial instruments actually are. Financial instruments are a contract which gives rise to financial asset on one side and financial liability or equity component on the other side. Remember, a contract needs to exist, only then there can be a financial instrument, which is why if you're talking about any regulatory requirement, so tax cannot be a financial instrument because it's a legal requirement. Over here, we need a contract which gives rise to financial asset for one party and financial liability or equity component for the other party. Now, in case of financial instruments, what a lot of students find daunting is the measurement criteria for different financial instruments. I'm going to break it down for you on a stepwise basis and keep the discussion very focused to what is going to be tested in your financial reporting exam. So starting off with, we have financial assets, which are the financial instruments of the holder. So a person or a company has invested in financial instruments. That company is the holder of financial asset and therefore is going to receive income or earning on this particular financial asset. On the other hand, the party which has issued that financial instrument is called the issuer, and the other side can be either of a financial liability or an equity, or it can be a mix of both, which is called a compound instrument. In this particular video, we are going to bifurcate all of these and talk about their recognition and measurement criteria. Starting off with the financial asset, we are going to talk about classification and the initial measurement, then subsequent measurement, same for financial liability, initial measurement and subsequent measurement, and in the end we are going to talk about compound instruments, how they are measured initially and subsequently. Financial assets by definition are either cash or a contractual right to receive cash or another financial asset, or it can be an equity instrument of another entity. But it is a contractual right to receive another financial asset. Whereas when we talk about financial liability, it is an obligation to deliver cash. A contract, so a contractual obligation to deliver cash or another financial asset by the entity. When we talk about equity instruments, these are what a contract has as a residual interest in the assets of an entity after deducting all of its liabilities. Now let's move on to the measurement criteria and classification with respect to financial assets. In case of financial assets, there are 3 categories at which they can be classified. The first bifurcation is that we need to identify whether the financial asset is an investment in debt or it is an investment in shares. In case of investment in debt, the classification can be done either at amortized cost, which is for long-term investments held till maturity. The second classification is fair value through OCI, which is medium-term investment expected to be held for some time, but not till maturity, so expected to be sold before maturity. And the last is fair value through P&L, what we call the default category, in which short-term investments which are held for trade are classified. Now, in terms of amortized cost. Remember, the main criteria is with respect to amortized cost. Now, the standard says that in case of amortized cost, when we say intended to be held till maturity, we need to apply two tests on it. One is the business management model test and the other is contractual cash flows characteristic test. Now, in this case, if the company intends to get the principal amount of that particular debt as well as the interest, and the interest is a combination of time value of money and the credit risk associated with it. So, if the company has the intention to get both of these till maturity, only then the item can be classified at amortized cost. This is very important. If that's mentioned in the question, you are going to identify it and categorize that particular investment at amortized cost and do the accounting accordingly. Now, the next thing in this case is that if the investment is not in debt, rather it is in shares, then it cannot be classified at amortized cost. Yes, it can be classified at fair value through OCI, but only if the shares are not held for trading and this irrevocable election has been made at the date of acquisition. And then if that is not the case, then the default category is fair value through profit or loss. We are going to talk about the accounting in detail for all of these shortly with a practical example, but please do keep in mind that these kind of classifications can come up anywhere in your exam. So you may get an OT in which you are given the circumstances and you have to identify under which model is the financial asset going to be categorized. So out of the financial instruments, we are dealing with first part, which is financial assets, and we have seen the possible classifications that can be done. In your question, look whether it's an investment in debt or shares and classify it accordingly. Now that we are done with the initial classification, we can see that how initial measurement is done. By now we know the category under which our financial asset is going to be placed. Starting off with the measurement criteria with respect to the financial asset, let's see what is the accounting that is done by the holder. The first thing that the holder needs to see for initial measurement is that if the financial asset is held at amortized cost or at fair value through OCI, then the initial measurement is going to be done at purchase price plus transaction costs. However, if the financial asset is held at fair value through P&L, then the initial measurement is going to be done at purchase price only. The reason for this is that the transaction costs are also going to go in P&L. If we add it in the value over here, then at the year end, again, we will have to charge it to P&L as a difference between the opening fair value and the closing fair value. So remember, for amortized cost and fair value through OCI, transaction cost is going to be added to the cost of asset. When we talk about the liability portion, then in case of financial liability, the initial measurement is done either at amortized cost, in which case we need to have the proceeds received and we subtract the transaction costs from it. On the other hand, if the liability is being classified at fair value through P&L, then the proceeds received are going to be the value at which the financial liability is initially recognized, the logic being the same as fair value through P&L for financial asset. As you can see over here, financial liability can be held at two models, which is amortized cost and fair value through P&L. So this is your initial measurement and classification for financial assets and financial liabilities. Now, one interesting point over here is with respect to transaction costs. At times, students do get confused whether the transaction costs are going to be added to the value of the financial instrument or subtracted. Now, in case you don't remember it in the exam immediately, just quickly write the double entry for financial instruments transaction costs and you will remember it. Now, when you pay the transaction cost, you're going to credit the bank, and against that you have to debit what? The financial instrument. Now, if we are dealing with a financial asset, which is a debit balance, then any further debit to financial instrument is going to be added to it. Therefore, the transaction costs are added to the purchase price of financial assets. Whereas in case of a financial liability, we have a liability existing, which is a credit balance. When we pass the double entry debit financial instrument credit bank, then financial instrument is being debited, and therefore the transaction costs are subtracted from the proceeds received in case of amortized cost model. The accounting treatment is a mirror image of both financial assets and financial liabilities. We're going to cover financial assets in great detail shortly. Now, let's see an example over here with respect to the financial assets. We have a acquisition of loan notes by the holder, and the par value or the principal amount of these loan notes is 12.5 million. Now this is the original value, or what we call nominal value, face value. Basically the legal value of these financial assets is 12.5 million. This has been issued at a discount of 23%. Now let's stop over here and see that how much did actually the loan holder pay to get this particular financial asset. You see over here, we just discussed it in the previous slide that we need to see the purchase price. We haven't mentioned that we are going to talk about par value. So we are going to calculate the value which has actually been paid. Now we are going to take 77% of this 12.5 million, which gives us the figure of 9.625 million. That is the amount that we have paid to acquire this particular loan note. Then there were transaction costs of 375,000, but by this point we don't know at what model is it being classified. If it is at amortized cost or fair value through OCI, then we'll add it in the value of the purchase consideration. Otherwise, we won't. Next is the effective rate of interest. Now the effective rate of interest 10% is going to be applied on the brought down value of the financial asset, which we have just calculated, and we are yet to decide about the transaction costs, whether they are going to be added in it or not. But basically this 10% is going to be applied on the brought down balance. I'll show the mathematical working of this also shortly. This is the rate at which we are going to recognize our income. So effective rate of interest is going to show us the income earned on these loan notes. The next is the coupon rate of interest. This is the amount at which we are going to receive the interest income. This is 4.7%, and this is going to be applicable on the par value of the loan notes. It says that the loan notes are redeemable at par in 5 years' time, and in the end the question says that the intention is to hold them till redemption, which means that these loan notes are classified at which model? Amortized cost model. We just discussed this. Now let's do the calculation part of this working. Here, when we are talking about the initial measurement, let's see the initial measurement first. So in case of initial measurement, now we know that this is held at amortized cost. So transaction cost needs to be added to the initial proceeds. 9625,000 is what we calculated by applying 77% on 12.5 million, because there was a 23% discount on issuance. Add to it the transaction cost and the amount at which we are going to initially measure our financial asset is 10 million. So the double entry in this case is going to be debit financial asset by 10 million and credit bank by 10 million. This is the investment that we have made. Now when we talk about the subsequent measurement overall, please see that something which is worth 12.5 million, and it is going to go back to this price because that's the par value of this investment. We have purchased it for 10 million, which means that we are going to get a gain just by the change in value at which we got the loan notes and at which it is going to go back to. That difference is 12.5 million. So it is a gain of the holder. Other than that, the holder is going to earn interest income also. This is going to be 4.7% on 12.5 million, and that is going to be for 5 years. So the total amount that comes up over here is approximately 2.938, which means that the total gain or the overall gain for the holder which is going to be charged in P&L is 5.438 million. However, if we just charge the interest income at 4%, 4.7% per annum, which is going to be the amount received every year, then we would be showing only the 2.938 million income. Now, actual gain is 5.438. What we are getting to show in the financial statements is just 2.938. How do we ensure that the 2.5 million gain is also shown in P&L, because this is also something which is accruing over the life of the loan notes. This is precisely why we have the effective rate of interest. The effective rate of interest incorporates all kinds of gains which are going to be earned on this particular investment. Now let's make a full-fledged amortization schedule for the financial asset at hand. We start off with 10,000, which is the brought down balance. Remember, not the par value, but the actual value at which we have initially measured our asset, which is purchase consideration plus the transaction cost. On this, we recognize the interest income using the effective rate of interest multiplied by the brought forward balance. That is 1,000 over here. Then we move towards the interest received, which is 4.7% of the 12.5 million par value, that is 588. That's going to remain constant over 5 years. We have the opening balance. To it, we add the interest income, subtract the interest received, and the balancing figure is our carry down balance. This carry down balance is going to be the brought forward balance in the next year. Same working, 10% is now applied to 10,412. These workings are in dollar thousands. Interest received is 588, balancing figure is 10,865. And as we do it, you see that at the end of the life, which is at the end of 5 years, the value goes back to 12.5 million. There is a small rounding difference in it, but basically it is going back to 12.5 million, which is the par value of this loan. So this is how effective rate of interest makes sure that the value of the instrument at the time of redemption is the same as its par value. In your particular exam, please be very careful about the year that the examiner is asking you to do the accounting for. You will not be required to make this complete schedule for 5 years because the examiner wants to test your concepts and not really your math skills. But it is always possible that the examiner asks you to provide the figures at the end of year 2 or at the end of year 3. Now, in that case, you have to make the schedule till the end of that year to identify the interest income, interest received, and the carried down balance. So please see the dates very carefully. Another twist that may come up in your exam is that, especially in the section C of your exam, the final accounts questions, that the examiner says that the company has only recognized the interest income which has been received. So the cash which has been received, which means that no other entry has been made and the interest has not been recognized at the effective rate. In this case, we are going to follow the approach as to what should have been done, what we did, and now what do we need to do to correct it. Now the correct entry from the example that we have just done is that if the interest income in the year 1 is 1,000 using the effective rate of interest, then we should credit interest income of 1,000, debit bank by 588 the interest income received, and debit the financial asset by 412, which is causing the increase in the value of asset over the years. Now, if that's not the case and the company has only passed the double entry, debit bank, credit interest income by 588, then we need to pass the corrective double entry in which we debit the financial asset by 412 and credit the interest income also by 412. This income is also going to be shown as an income in our statement of profit or loss. Now, this was the working for the financial assets at amortized cost. Now let's move to the measurement of financial assets at fair value through OCI. Now the interesting part in case of fair value through OCI is that although it is an asset which is held at fair value through OCI, the change in fair value does not take place from the start of the year to the end of the year. Rather, we do the same working that we do for the amortized cost. So if you see the year one working, we started off with the 10,000 brought down balance. Interest income is 1,000. Interest received is 588 and the carried down balance is 10,412. Now the interesting thing is that at this point in time, we go to the market and check the fair value of this instrument. Let's suppose the fair value of this instrument at this point in time at the year end. Both the figures are at year end. Our working shows a carried down balance of 10,412. The fair value is 10,500. We find the difference between the two. 88 is the gain in value. We are going to charge it to OCI. Now, the next year, please note, the brought down value is not going to be 10,412. It is going to be 10,500. Same working, we apply the effective interest rate to it. We subtract the interest received. We have the carried down balance 10,962. At that date, we evaluate the fair value again and it is 10,400. Now, the comparison over here is going to be between 10,962 and 10,400. This difference of 562, which is the loss, is going to go to OCI. This is how the working is done, so on and so forth. I've just taken an example. It is going to change with the fair value at every year end. Now, I want to take you to the Study Hub by ACCA to show you a very interesting chart which talks about where in the statement of profit or loss and OCI are the incomes and the gains going to go. So let's move to the ACCA Study Hub. Here is the chart. You can see that for the financial assets, we have the items at amortized cost, at fair value through OCI and fair value through P&L, just like we discussed. For the debt instruments, the interest income is going to go to the investing category of statement of profit or loss as per IFRS 18 format. For the remeasurement, this is not applicable over here. In case of fair value through OCI, the interest income, again, just like amortized cost, is going to go to investing category of statement of profit or loss, whereas the remeasurement to fair value is going to go to OCI, and this is going to be reclassified to statement of profit or loss. This is something very interesting, that in case of debt instruments, the gain or loss that goes to OCI is reclassified to statement of profit or loss. For the fair value through P&L, it is going to go in the investing category of the statement of profit or loss, whether it's interest income or it is the gain or the change in value of the instrument. Now, let's compare this with the equity instruments. If a company has made the investment, the holder has made investment in equity instruments of another company, then amortized cost is not applicable. When we talk about fair value through OCI, the dividend income is going to go in the investing part of the statement of profit or loss as per IFRS 18, and the remeasurement gain or loss, that is going to go to OCI, and that is never going to be reclassified to statement of profit or loss. So that's the difference, a very minute difference between debt instruments fair value through OCI and equity instruments. Please keep this in mind, especially for the objective test questions in this section A and section B of your exam. Whereas in case of fair value through P&L, it is straightforward. Any kind of dividend income and the remeasurement to fair value is going to go to investing part of the statement of profit or loss. Coming back to our main presentation, we just saw how the presentation is going to be done in the statement of profit or loss for financial assets, any gains related to them or any interest income related to them. Now, when we talk about the financial liabilities, how they are going to be presented in the statement of profit or loss. So in such cases, we are going to go for the profit before financing and income taxes. From that, we are going to subtract the interest expense on borrowings and lease liabilities. So interest expense on borrowings is what covers the financial liabilities also. This is the financing part of the statement of profit or loss, and after that we reach the figure of profit before income taxes. Now, just a quick review from where we started. So, we talked about what financial instruments are. From the holder's perspective, we talk about the financial asset, its classification, initial measurement, and subsequent measurement. Um, Please see IFRS 9 is very easy. If you understand in smaller chunks the individual accounting treatment, it is something very easy and very clear, and it does not get tested beyond a certain level of difficulty in the FR exam. So you need to have a very exam focused approach over here. From the issuer perspective also, we talked about financial liability, the two models at which it can be classified, how the interest expense related to this is going to be classified, the working that we did for the amortization schedule of the financial asset at amortized cost, exact reverse of it is going to be done for the financial liability. Then we have equity component and the compound instrument. In the compound instrument, now let's see how initial measurement and subsequent measurement is done. Now, compound instruments, which are also called convertible instruments, they have the certain proceeds which are related to them. So if the company is the issuer, now compound instruments are only tested from the perspective of issuer in the financial reporting exam. So from the issuer perspective, because this is going to be at the liability side, the proceeds have been received and these proceeds now need to be classified between financial liability, which is going to be the future cash flows if the equity option is not taken by the holder. So another party has a right either to take cash from the issuer or to take shares from the issuer. So in the financial liability, we are going to assume that the holder is going to take cash from the issuer, and in that case, we are going to recognize the financial liability. Because this is going to happen in the future, we first identify the cash flows and then we calculate their present value. These are discounted at an interest rate applicable if there is no conversion option related to that loan. In your questions also, you will always be told that the compound instrument is at, let's suppose, 5% rate, and the same debt without conversion option is, let's suppose, at 8%. So the discounting is always going to be done at the open market rate, the interest rate of the loan without conversion option. Now, in this case, we use the same kind of working which we used for the amortized cost method. So we calculate the brought down value, we charge the interest expense, we subtract the interest paid, and balance figure is our carried down balance. So effective rate, a nominal rate, same kind of working is done that we did for the amortized cost. Now, the next part is the equity. Equity, as you know, once recognized is never remeasured. So we recognize the equity only once, that is at the date of the issuance of the convertible loan notes or the convertible instruments. The value of equity is calculated as the total proceeds minus the present value of the financial liability that we have calculated at the date of issuance. This working is then not going to change throughout. There is no unwinding interest, any such thing is done on equity. The balance is going to remain the same till the time of redemption. I want to show you a practical example of this also through the ACCA Study Hub. So let's move over there. Here we are in the ACCA Study Hub. You can go to this chapter 18, which is related to financial instruments. I have given you an overview of the whole standard. You can read about individual items in detail over here. Here we have the compound instruments that I wanted to show you. Now in here, we have the example that a company issued 10 million convertible loan notes at 5% rate. By chance, the example is the same as what I gave you, and the interest rate without conversion option is 8%. Now, in this case, the discount rates are provided to you in the question. This is mostly there in your final exam also. Here is the calculation for the present value of liability. We first calculate the interest which is going to be paid on a year-on-year basis. So for 3 years, the company is going to pay 5% of 10 million, which is 500,000, thousands combined, 500. And then at the end of year 3, they have to repay the principal amount of loan also, which is 10 million. We apply the discount rate and we get the present value of 9229. This is going to be the present value of loan or the brought down value of the loan at the date of issuance. On this working now, the remaining amortization schedule is going to be made. To calculate the value of equity, we subtract this amount by the principal amount of loan. So 10 million minus 9.229, this gives us the value of equity which is recognized. Here is the double entry that is going to be passed: debit cash, credit liability, and credit equity. Now with the cash amount, because that's the opening value of our liability, we have the opening balance. We charge the finance cost or the interest expense at 8%, which is going to be 738. The interest paid is going to be 500 and the balancing figure. Then the closing balance of this year end is going to be the opening balance of year 2. Then we charge interest expense on it again at 8%, the effective rate of interest on the opening balance. So 8% is being charged at 9467 to get this value of 757 minus the interest paid, and balancing figure is the carried down balance. Such more examples are also available in the financial instruments within the study hub. I would request you to go through the topics and attempt the questions from the practice which is available over here, as well as the ACCA practice platform. Once the control is lost over these financial instruments, then we are going to de-recognize them. So this is all with the financial instruments. Please practice, practice, practice. Do a lot of practice of this topic for you to get a good grip of what kinds of accounting treatments are tested. There is a very repetitive pattern of testing for some areas of the standard. If you practice properly, you can easily attempt them in your exam. I hope you found the video useful. Best wishes for your financial reporting exam. Thank you.